Many retirees come to us and are searching for that one golden thing to provide reliable income, but not all income strategies work the same way, and not every income strategy is right for each person. And there's also the risk part of it. Certain people like risk, certain people don't like risk. Today, we're going to break down 3 common retirement income tools: dividend stocks, annuities, and bonds, and talk about what each does well, where they fall short, and why many retirement plans use a combination of all 3. People feel that when they invest in dividend stocks, there's a chance for growth. I'm going to call it one of the pluses. You're not giving up growth as much. So the dividend stocks, we expect them to still gain because you expect those companies to want to do good. And a lot of times when you take those bigger companies, they're paying out those dividends and they don't want to reduce their dividend. Because when you start to look at it, if a company reduces their dividend, it's a sign of weakness. So what happens? Shareholders start to sell and leave the company and they'll go invest in someone else. So a lot of these bigger companies, when you're looking at them, they're kind of stuck paying that dividend. Use it to your advantage. So when you're building a dividend portfolio, the plus is you're expecting money to come to your account, usually quarterly, from these companies, and then adding it up and you're drawing from those dividends every single month. So you kind of divide it and draw from it. So it kind of helps offset inflation because money's coming in off the dividend and then you're getting some growth off of that stock. I feel it gives you flexibility too, because if you run into an issue and you want to sell off some of it, then you can say, well, I got X number of dollars coming in. It's okay if I sell off a little bit because I'll still have Y coming in. It's still helping to cover my expenses. So it gives us a little flexibility in the planning. But guess what? In 2008, when the market really fell apart, some of those companies cut their dividend. Some of them actually cut it down to 0. So it's not a guarantee that those dividends will be paid. You just expect them to be paid. But the thing is that it could actually be reduced or eliminated. And then guess what? You got to change your plan around a little bit. So that's a danger. The other piece is if you're someone that doesn't like a lot of risk, dividend stocks are stocks. Stocks, guess what? They're risky. They do fluctuate. So if you're someone that doesn't like the ups and downs, maybe a dividend portfolio isn't for you. If the market goes down early in your retirement and you're drawing against your accounts, it's hard to make back the money. Whereas if the market's going up in the beginning, then when you're drawing, a lot of times you're drawing from gains. So depending on market conditions, it could change the effects of a dividend portfolio. So next topic I'll cover is annuities, because that's another income tool. There's multiple ways to use annuities. Sometimes you could set up a fixed income stream off of it. Sometimes people will set up an annuity just for a little bit of growth and they draw a chunk of money out of it. So it really depends on the case is the best way to put it. What's right for you? So I'm just going to cover the one that pays out like a pension, where it just pays monthly. You can actually hand an insurance company money, not that you're taking cash and handing it to them. but in theory, what you're doing is you're putting money into an account with an insurance company. And then what they're doing by the contract is making a promise to pay you money monthly until you pass away. You could do it for a single person. You can do it for a couple. So the pluses of it, one of the big pluses is, hey, that income's not going to change. You can't outlive that income stream either, because let's say you're someone that lives to 100 and you would have run out of money at 90, but this thing here just keeps paying till you pass away. There might be nothing left to go to beneficiaries, but at least it took care of you. And it's predictable. You know how much is going to show up every month and you could budget around it. Weaknesses, less liquidity. When I talked about dividends, you could take money out of those accounts. A lot of these, when you start to take a monthly payment, you really don't want to touch it because it really take extra out of it because it actually hurts the payment coming out of it. So I just say limit liquidity. If you're going to do an annuity, and it depends on type of annuity, but if you're going to do one that's going to pay you monthly, you got to say that money that's going in there, I just want the monthly payment. And they just kind of assume that's all you're going to get out of the thing. And you have to be careful when you're looking at these companies. Some have high fees. Sometimes some of them have complex contract features. So it's really digging into it. I'm going to say that these annuities are best for retirees that are focused on income and they don't want to think, they just want the money to show up. They also might be risk averse. So the thing is if these annuities are paying monthly and the market's bouncing around, they don't feel it. And another piece of it too is some people just like it set. Like, I know it's going to cover my expenses. I don't have to think about it. And it's just that comfortable feeling. Last piece that we use for income, bonds. And when you think of a bond, typically what you're doing is you're just giving a company money or even government. Let's say I'm buying a Connecticut bond. I'm actually giving the state of Connecticut money and they're giving me interest. And at the end of the term of the bond, I get my money back too. Like buying a CD, you get interest, right? And then you get your money back later. But best way to put it, bonds usually don't bounce around as much. But the thing is sometimes if interest rates go up too fast, bonds could actually go down. So let's talk a little bit about strengths. Provide relatively predictable income. You know the interest payment when you go into it. You know what they're going to give you. Less volatile than stocks. I know I already mentioned that. And can help reduce overall portfolio risk. Think about it. Stocks bounce around a lot more. They're more volatile. Bonds typically a little bit more. They'll still bounce around, but the volatility typically isn't as volatile. So people are a little bit more comfortable with bonds. Plus we have interest rates right now. So bonds actually pay out pretty good compared to what they did back in 2022. And one other plus of bonds, if you don't like the way it's going, typically you could sell it before they mature. Sometimes you come out on top. Sometimes you take a little bit of loss when you do that. So it's something to consider. Weaknesses. Fixed interest payments may not keep up with inflation. A lot of us remember back before 2022 when they started raising interest rates on us, we had a lot of inflation. Bonds were not keeping up with inflation. So people had to find different things to do. Typically, when you look at long-term returns, stocks outperform typically, and then income ends at maturity. So when the bond's done, the income ends and you have to find another income. So people sometimes view that as a weakness because they're like, oh, I got to shop again. What I would say, bonds best for short and midterm income needs, conservative investors, and retirees seeking portfolio stability. They just don't like that volatility. And so if you were to ask me today, which is best, the problem is there's no best. It really comes down to customizing that plan for someone. A couple of things I'll touch on. Dividend stocks offer income and growth. Okay. Some people might be okay with the volatility. Bonds, a little bit more stability, a little less volatility, may not keep up with inflation. And then annuities, for those that just want income showing up, it's that income that you sign the contract and they keep paying you until you pass away. So it really comes down to your plan. I have to come up with ways to help people get through retirement. And sometimes you end up with a little bit of each of these or only two of these, but you're covering different things that happen within the market and helping someone get through retirement. So instead of asking which one is best, the better question may be, what role can each play in my retirement plan? How can it help me? If you'd like help evaluating how dividend stocks, bonds, and annuities may fit into your income strategy, reach out to us. Visit our website at tfcheckup.com or click on the link below.